So I want to dig in a little bit on the second and third. You mentioned second and third. I know one of the kind of euphemisms the private equity group refer to as the second bite of the apple. So for my listeners, again, you sell whatever, 70% of your business, you roll over 30, and ideally that 30 then ultimately becomes liquid when the private equity group sells to whoever is going to own the business 5, 7, 10 years down the road.
Probably another private equity firm.
Likely another larger, because these guys do operate in revenue bands, right? Like some private equity groups like businesses that are 600 million to $1 billion. Others like them 6 to 60 million. I mean, there's all kinds of.
There are 5 layers to the private equity pyramid, and if you keep in mind that all of these firms have about 5 years to build their investments and then sell them during this 10-year lifespan of the fund. It's like they don't have 10 years because they don't find all the companies to buy on day one. It may take them a few years to find a good company and then buy it. And so they have a 10-year window with which to own a company for about 5 years on average. And so the amount of growth I can get done in that 5-year period and the size of the PE firm that I am and the size funds that I raise dictate the size of company that I buy, the size I build, and the size at which I sell. And capital is very disciplined, and it's going back and forth in these 5 layers, looking for things to buy at the bottom of its band, take it up to the top of its band, sell it upstream to the next PE size groups that are looking at the lower. My upper is their lower, and this goes on 5 times between startup and public company.
And what are the 5 layers?
So think of it this way. If you think of it in terms of EBITDA, which is really how the pyramid is wired, most companies are bought and sold as a multiple of EBITDA. So earnings before we buy stuff. That's how I describe EBITDA. So 0 to 15 million is the traditional bottom layer of the pyramid. 15 to 50 million is the next layer, and then 50 to 100 is the third. 100 to 200 is the fourth, and 200 to public company exit is the fifth. And now, because so much capital has been coming in to private equity, not enough good companies to buy, there's been some flexing down of these swim lanes, I call them. And so people who used to buy at 15 now will buy as low as 10. And instead of selling at 50 now, because the 5 years they're starting lower, they don't get as far. Now maybe they're selling at 40. And people who used to buy at 50 are buying at 40, and maybe they're not getting to 100, they're getting to 80. And so all of these private equity pyramid levels have kind of flexed down just a little bit. And what you have right now is, just right this second while we're talking, there's 1.9 trillion in committed capital looking for stuff to buy. Not enough good stuff to buy, so it seeks something smaller. It goes down the food chain looking for a good deal that hasn't yet fully matured. I'm going to buy green bananas because I know eventually they'll become yellow bananas if I put them on the shelf long enough.